Thank you very much, Michael. Jay?
Michael, thank you very much. And thank you all for being here and taking the time to hear what we at STF have to say. The presentation is called Accessing Tactical Asset Allocation and Income with ETFs. And especially, I think it's very relevant in today's market environment, especially given all the volatility, is to have an investing game plan to navigate any kind of market environment we have. And certainly there's been a lot that we've seen this year that many of us have never seen before in terms of how the market has reacted, what the market has done, and just the unprecedented amount of information and volatility that we've seen so far this year. And what we want to do is introduce a strategy that, while, as Michael alluded to, is new in an ETF wrapper as of about 4 weeks ago, is not new in terms of its usage across different wrappers, specifically the Tactical Growth ETF TUG. We'll get into a little bit more about that in a minute. So we'll talk about that. The other side of this too that I wanted to mention too is just the income. More and more today, the average investor, as many of them are reaching retirement, are looking for income, ways to generate consistent income, and doing so in an environment where fixed income has been as volatile as stocks have been. And so we want to talk in the presentation, talking about ways to access not only systematic rules-based tactical allocation portfolios, but also do so in a way that could potentially generate monthly income within the strategies. And so with that, before we really jump into the meat of it, I wanted to spend a little bit of time talking about STF, who we are as a firm. And again, just launching ETFs in market about 4 weeks ago. The firm is headquartered in Frisco, Texas, which, if you're not familiar with Frisco, is just north of the Dallas area, which Thomas and I are both recording this session live in Frisco, Texas. And we are comprised of a group of financial professionals that range, as Michael alluded to, a lot of different industries, whether it be hedge funds, investment management companies, insurance companies. And as Michael alluded to, I came from NASDAQ Dorsey Wright, having started my 17-year career there. And back at the end of 2020 is where I had the opportunity to actually meet Thomas, partner with Thomas, who had been running an investment advisory firm for the better part of the past 15 years prior to us meeting, and had investment strategies out in the marketplace, tactical unconstrained growth. And I heard what he was doing with a partner of his by the name of Jonathan, who I'm sure we will all talk to at some point with follow-ups. But I heard and got so excited about the opportunity and what they were bringing to market, not because it was a new ETF, because they were solutions that are for investors of all different ages. And so we'll dig into that a little bit, but that's a little bit about who we are in terms of our team that we've assembled and put together. Tactical unconstrained growth. You've heard us mention that a couple times, and I will not by any means take credit for the naming convention of tactical unconstrained growth. I will let Thomas take credit for all of that. As TUG, Tactical Unconstrained Growth, is very simply the name of the investment strategy, as it has been since it's been running since about 2014, primarily on the platforms of managed account operators at a very large insurance company. And so one of the aspects that we're very excited about is to bring this strategy, TUG, or Tactical Unconstrained Growth, to a market that it was very limited in terms of its ability to be used, because it was confined to just a couple of platforms, albeit at a very large insurance company. And so the Tactical Unconstrained Growth strategy, again, has been utilized. The underlying methodology has gone back to 2014. So while it's new in an ETF wrapper, it's not new, it's an investment merits, and it's actually seen and shown the ability to navigate different investment environments over time. And so what is TUG? At its core, I've mentioned this, simple and rules-based. It's very much rules-based. Thomas created the TUG strategy a number of years ago, but we don't let him put his own human intuition in it. The rules are set up in such a way that they are designed to make asset allocation decisions, toggling between owning equities through the NASDAQ 100 index, or owning bonds, or owning cash, or some combination thereof, to toggling basically between risk on environments and risk off environments based on what the market is actually doing. We're not trying to predict what the market should be doing based on number of factors. We're looking at price trends and price movements of the actual indexes relative to each other to understand what the market is actually doing, how investors are out there casting their votes with their actual dollars and letting the system make decisions based on those inputs that we're seeing, based on the price action of indexes, specifically on the equity side, the NASDAQ 100. And again, new to ETF, not new to the investment world, as that has been running since 2014, with analysis that goes back many years, because it's looking at price in terms of its equity allocation. The NASDAQ 100 has been an index that's been trading for many, many years. So there's lots of data, lots of history that we can go back and look at analysis that expands back over a number of decades. Again, just looking to see whether we want to be invested in equities in generally rising market, or are there other asset classes that are better to invest in, i.e. fixed income or stocks. We'll dig into the rules and how that looks a little bit more in a minute. But again, the tug strategy, again, it's really designed to be a tactical asset allocation solution to own stocks, be invested in the markets when the equity market's generally rising, and attempt to de-risk the portfolio in markets where equity indexes are generally falling. And what that means at the end of the day for the investor is that it has the ability to play both offense and defense. And that's one of the things that I always think about. And if I think about sports, a lot of the NFL mini camps are coming back into session. The Cowboys here in the Frisco area are coming back. And if you think about, you're a football team, if you only had the ability to play offense, how good can you be? How good are you going to be at preventing the other team from scoring? And vice versa. If you only had a defense, well, you might be able to stop the other team, but you won't be able to advance the ball and score. And with our investment strategy with TUG specifically, it gives us the flexibility and ability to not only play offense and participate in a rising market, but also has the ability to play defense when the market is pulling back and correcting. So with that said, that is a general highlight of TUG. And why is that important when you think about the ability to not only play offense? I think we all understand why playing offense is important, because we can make money as the market's going up. But there can be very long stretches in the market where the market is not really doing anything. It might be doing a whole lot, but there's nothing really going on there. And, it takes me back to what many called back at the end of 2009, which was the lost decade for investors. If you look at a chart of the S&P 500, the S&P 500 made basically 4 different 20% movements, 2 up and 2 down over that decade. However, if you had invested basically $10,000 at the end of 99 in the S&P 500 and just held it for the entire decade, you would have actually lost money. You would have been underwater over that 10-year period. And so it's periods like that it's very, very important to have a game plan to understand when markets are generally rising, or understand are there better asset classes to be invested in to not only preserve capital, but also see some appreciation from it. The next decade was very different. If you look at the S&P 500 or the NASDAQ 100, since the end of 99 through basically the end of 2019, so that next 10-year period, it looked very different. The S&P 500 was up almost 200%. The NASDAQ 100 was up almost 390%. So 2 very different outcomes in those next 2 decades. Well, I don't know. I don't think we can sit here and say, well, the next decade's going to look like the previous one or the one before it, which is why it's so important to have a systematic rules-based plan to help navigate whatever the market brings, whether it's another 10 years of nice growth and performance with equity indexes like we saw the previous 10 years, or if 2022 is the beginning of 2022 is any telling sign to what the next decade may bring. We don't know, and we're not going to look to predict the future, but what we're going to do is we're going to take all of those inputs and we're going to allocate based on where the market is going, not where we think the market should be going. So with that said, I am going to turn it over to Thomas, who everybody is here to hear from more so than me, as Thomas is the architect of the TUG strategy, co-CEO, co-founder of STF Management. So Thomas, I'll turn it over to you.
Great, thank you so much. What we want to go through now is how does it work? And at the end of the day, what Jay talked about, the reason a football team gets together for a mini camp is because they want to go through their plays until they're ingrained in their heads, so that while they're on the field and they're in the thick of it, they are not trying to think their way through this. They're not trying to balance what they know in the past, their emotional state, the circumstances. They want to basically have had those decisions made so that they can just simply act in the most appropriate way. That's the problem with us as investors right now. We feel like we're in uncertain times, or we feel like we're in brand new times, and we do not know how to respond to that. That's the value of having an algorithmic system, because you've made those decisions when you had a clear, unemotional chance to go off and look at all of the available data. We're going to look at how TUG does that right now. And again, we describe TUG as simple, transparent, and focused. And that's what STF stands for. We want to hopefully demonstrate that to you here in just the next few minutes. At the end of the day, tactical systems always get their strongest signals in either a bull or bear market. When the market is moving up or down, you usually get your strongest opportunity in a tactical system to allocate correctly. For us, the other condition, which is a sideways market, is the one that most people need to be reminded of. And so as you think about how you would explain this to your end client, you almost always have to remind them markets go up and down and sideways. Sideways for us, of course, of the tactical system is usually the most challenging, because again, it's in a sideways market that you get whipsawed. As a tactical system sees strength as the market's moving up to the top of its range, it generally wants to be invested just in time for the market to start to move to the bottom of its range, and they start to get defensive, or they even try to take advantage of it just in time for the market to move back up to the top of the range. It looks like me on a dance floor, one step behind the beat of the music, stepping on everybody's toes. Nobody's having a good time. How do we solve that problem? Well, for TUG, the solution was not to try and solve it with more equities. The solution was to try and solve it with an entirely different asset class. In this case, we try to use long duration government bonds as much as possible. So as we see the market trying to break down in one way or another, we want to move into these bond positions. We want to move out of stocks, because being in stocks incurs risk with no opportunity for reward when the market is range bound. As we take a look at how we invest in our equity markets, the reason for the declining scale, as you can see from the left-hand side, is as the bull market starts to recede, or we start to see price volatility, we will withdraw our full-on exposure to the NASDAQ 100 in this case, and then start to bring in these fixed income investments. You'll notice that, again, as we said, by the time we get to a full-on sideways or range-bound market, we're 100% fixed income. But further off to the right-hand side, as we see a bear market developing, in this version, we do not go short equities, but we stay long bonds, or that's the intent. Because again, there's plenty of evidence. You go back to 2000, 2007, 8, 9, et cetera. One of the two asset classes that worked best in 2008 was obviously long duration government bonds. It's not the case currently, but we'll talk about how this strategy doesn't work in just a moment. To this point, TUG moves relatively quickly. I'll give you two examples. So in November of 2021, right before Thanksgiving, was the last time the TUG signal said that you should be 100% long the NASDAQ 100. That seemed probably pretty early as you look at what happened in December into the very first day of January's trading day. But as you look now at a chart over the last 6-7 months, that call starts to look pretty strong. Same thing happened in March of 2020. The market reached its top in February 19th. By 3 trading days later, TUG was already signaling you should be 20% in bonds. So TUG can make relatively quick calls to reduce exposure, not to get out, but to sit there and say there is something significant that's going on. And in that environment, we want to do what? We want to reduce and pull back on our risk exposure. Well, going to go down to this next one. Now, at the end of the day, like I said, for us, one of the things that can happen is when we go off to the right-hand side, as we take a look at what's happening with the markets, we end up in a sideways market or a bear market. What if the market is bad on that side, i.e., what if bonds are as treacherous as stocks? Well, this is when we start to bring in cash. TUG never naturally calls for a cash position because nobody's interested in paying us to watch them manage cash. However, we can end up in cash because if bonds and stocks are both bad, why would you want to own either of them? And for us, the third equivalent, or the third place that we can end up, is in cash equivalent positions. You'll see that that is where we are predominantly today. This is the most important thing I want to share with you. And in fact, I think this is one of the most important things that you can share with the end client of this. At the end of the day, There are specific ways and specific environments that tug is going to, let's call it, disappoint or frustrate you as an investor. What's fun about having a simple, transparent, focused system is I can tell you what those environments are going to look like before they occur. That's the nice thing. As a design element, you know that you don't want to take a Corvette out onto a snowy, icy road in Minneapolis, St. Paul in February. And you should know that, because that giant powerful engine with that rear wheel drive is never going to get you through that snow and ice without wrecking your car. So calling back to General Motors and saying the car is broken or is poorly designed isn't really a good idea or a solution, because it's apparent to everybody what that is designed for, the environment it's designed to do well in, the environment that it's going to do poorly in. Same thing here. What we're trying to describe to you is there are two environments in which tug is going to struggle. And if you know those beforehand, you can set expectations. The first one is sideways in two market classes. So if you think in terms of like this in 2015, we have a NASDAQ 100 that's moving along toward the beginning of the year. We're looking at a 50 and a 200-day moving average, and it's moving along pretty well, but then it stalls. And so on this date right in here, when the NASDAQ lands on its 50-day moving average, tug would have did signal, in fact, that we need to have some bond exposure. And the next day, the market plunges. It's the first time the Dow lost more than 1,000 points in a single day. And tug, before the end of the day, would have signaled we need to close our NASDAQ 100 exposure. At the beginning of this, you think that sounds pretty good. The problem is what? Tug wants to move into bond positions, fixed income positions. We've listed a lot of them. I wanted to go beyond just in this case, beyond just what's happening with treasuries. You can see that most of these things are not doing anything. And in particular, in this range here, where tug is looking for the most help it can find from fixed income, it's not really finding anything at all to grab a hold of. So we end up now with a market that basically trades for the rest of the year around kind of a flat line, keeps coming back and forth to it. Bonds themselves are essentially either flat to slightly down. How do you think tug does in that environment? And hopefully you would sit there and say, not so great. And that's the problem. We call a sideways in two markets environment a laydown, meaning there's no wind, there's no energy in either of the two environments. Yes, you see movement, but at the end of the day, there's no displacement. You're not getting anywhere. And so for us, this is a boring condition in which the client wants to let go of the investment, not because it's losing money, but because it's not moving anywhere. The second one's a bit more dramatic. A breakdown in correlations, or what we would sit there and say when stocks and bonds are doing the same thing. Meaning the base understanding of tug is that if we're in a risk-off environment, people are selling stocks hand over fist. Generally speaking, that's because there's a threat to the economy, there's a threat to the valuations, and then people look to do what? It's about preservation. I want to make sure I don't lose any more of my asset base. And so generally what you see people is they rotate from equities into fixed income, and in particular, they rotate into government bonds. Well, I don't need to tell many of you on this. This is the worst bond market ever in US history. And so anytime that you see this kind of thing, we saw this in June of 2013 when Ben Bernanke announced the end of what he said was going to be the end of quantitative easing. Didn't say when really how it was going to happen, when it was going to happen, what it was going to look like, just that it was going to end. You can see on this date, the markets did what? They went down, and so did bonds. And so tug in this case says, I've got to get out of equities, at least partially. I've got to de-risk the portfolio. It moves from the green line into the orange line. How did that work out? We call this a drawdown. Drawdowns are dramatic and short in nature, meaning it's hitting something with that car analogy. It's hitting something in the road, and then for a moment afterward, you're going through all the systems. Is the alignment still good? Are the tires still round? Did I flatten something? And when you realize that nope, everything's okay, you get back onto that smooth and you kind of go back on cruise control and then you continue. But for that brief moment, you're what? Shaken, awakened to the dangers around you. And so drawdowns can cause people to react improperly as well. Again, I wouldn't be surprised if you guys, many of you out this call know, this has been the condition that tug has been struggling with the most this year, because as the NASDAQ 100 has dropped 30%, so have many of the bond positions, government bond positions that we've been in. And so in this case, tug has struggled to go off and find other places. And again, cash is our best bet right now to hide when both stocks and bonds are going down. So to that point, One size doesn't fit all. That's going to be true for why we offer two different versions of the ETF. But to you guys, this is the idea. We are going to talk about the use case for how you use TUG in your portfolio, because again, we feel it as very additive from that perspective. And again, this is a good tool in an overall asset allocation or portfolio place. We have our fact sheets are available out on our website, stfm.com, and then you go out under our ETFs and you can start to pull these down. You'll see some information about the strategies. Again, what we're going to talk about now is what happens next. So if we've talked about TUG and how it works, we're going to move into now TUG plus income, because this is, in my mind, really one of the more exciting components that we're offering to people right now. As Jay mentioned at the beginning, people are searching for if you're looking for an asset allocation program that doesn't just hold stocks as they go up and down, you would like to find something that generates income that isn't involved with an asset class that right now is being killed on a price basis. Yes, I may be getting a 3% yield on my 2-year note, but I have lost a principal value for that, and I potentially could lose more as interest rates continue to go up in the future. We're looking for a way that we can, if we can manage the allocation separate from market experience, how can we manage the income separate from market experience? And that's why we're looking for generating, uncorrelated income on a monthly basis. And this is an evolutionary process. Jonathan Molchan, again, it's been mentioned as the co-CEO and also the core portfolio manager. We talked a lot about this as we looked at making an ETF out of these two concepts. One being that in the past, these derivative income ETFs were very passive in their underlying exposure. The equity positions were just long passive, like we talked at the beginning of the presentation, and then a very simple passive buy right strategy on top of it. In 2019, the next step was to really go off and say, can we be more clever about when and how we are buying those puts and calls? In 2022, the solution was to say, let's look at now at what's happening with the underlying equity position. I may be doing a great job on the buy right side of the house, but if the underlying index is down 30%, that has an impact on the overall return of the ETF. So let's look at a way, can we find something that mitigates the market's experience? And this is where TUG plus income comes together. So at the end of the day, again, we're looking at the ability to generate a less correlated source of income compared to the use of dividends on stocks or the use of dividends with bonds in an attempt to dampen either the equity volatility of owning those stocks or the downside risk of, say, owning a fixed income product today. And again, we're doing it through a systematic approach. Everything that we talked about with TUG, having a rules-based system, is absolutely applicable to what's going on with the options side of the house. It is as rule-based, it is as unemotional, it is as already predetermined as anything else that we're doing in TUG. And yet, these things which are prescribed still find themselves able to adapt to current market conditions quite well. So again, writing call spreads in our case is where we tend to focus, right? We're going to go off and say we want to generate an enhanced yield that we would normally get over just our bond and stock positions that may happen to be in the portfolio as a result of the allocation program, and be very specific about it. So in a rising market, our long upside call options basically are fully financed due to our net credit that, again, provides us additional upside. We're in a position of buying a lottery ticket that we can then call if the market goes up over the next period of time. In sideways markets, again, we're able to go off and do what? We're generating just the spread. And that spread is what we're able to then return to the client. That helps us a bunch because, again, TUG in a sideways market is looking for additional returns. And then finally, in a falling market, the call options, the writing of them, the selling of them basically generates us some extra return and, again, some extra income that we're able to go off and focus on. For us, because TUG handles the downside, we're focused on the upside with our call spread option program. So TUG plus income really goes off and allows us, and this was the bring it all together sort of a moment, allows us to bring together an asset allocation program that's been running for a number of years, and then to it add this options overlay. So we are now able to add an income solution program to this long-running SMA system, and now put it in an efficient tax wrapper, i.e. the ETF. active ETFs in active strategies in an ETF wrapper solve for one of the biggest problems, as opposed to the little buys and sells that even if I only do 6 a year and I systematically said I was going to just rebalance every 2 months, everything that happens as a result of that will always be short term to the client. Inside of an ETF, we have a potential to go off and do what? Rebalance and create custom baskets that will help us to mitigate that. And so now the client really only has the implication of capital gains when they buy or sell the entire structure itself, i.e. when they get out of the ETF. So from that perspective, I'm going to turn it back over to Jay, because as he said, the important thing about this is you can take two very different people, somebody in their 40s and somebody in their 70s, and both make a case for why they should involve themselves with Tug-In.
Yeah, you're right, Thomas. And I think the point on the tax efficiency aspect of the ETF structure is extremely important and one that shouldn't be overlooked. I mean, when you take a managed account strategy that is generating a lot of trades, really the demand and the reason Tug and Tug-In became ETFs is because many investors that were owning Tug through a managed account strategy wanted to continue to own it, but wanted to do so with less tax burden. Mm-hmm. And by doing all of the trades inside of the wrapper of the ETF, and that's not an STF management thing, that's an ETF structure, ETF wrapper thing that has in-kind exchange, creating custom baskets to do all that work. We can dig into as many details about that as you want, but just knowing that having those trades that can be done inside of the ETF can help you defer when you want to pay taxes on the product, because you control that. You control when you buy and sell shares of the ETF, and you're not affected by other investors like you may be in a mutual fund, or by the decisions of the portfolio manager. So, that's why we believe that the ETF structure is the absolute right structure to be in. It also makes it available. It becomes platform agnostic. There's not one or two large insurance companies that control it. It now is available to buy across many different channels, and will become available across many different more. So where are we seeing this utilized? Well, Tug has been utilized for years as a means of helping manage risk within the overall market, and combining that with a different type of approach. Value investing, as an example, has a long history of doing very well, but it can go for very long periods of time, whereas you bring in something that is more tactically driven, they end up being very good complements together within a portfolio. I talk about, value investing and kind of tactical investing, or trend following type investing, as they tend to play well in the sandbox together. When one is not doing well, the other tends to hold up better, and vice versa. So you get this over time, these two investment styles and strategies that can have negatively correlated excess returns, and that's they play well in the sandbox together. They both have their strengths over time, and they work well together. But at the end of the day, when you think about yield, you mentioned the idea of something like Tug-In, growth and income. The Tug component of it, the only difference between the two is the income. Tug-In is going to generate, the goal is we're going to pay a monthly income, and we will do that here within the next 2 weeks, as we're still brand new in market. So in about a couple of weeks is our goal to have a first distribution based on the net credit of the call spread. But when you look at that at enhancing returns, we can do that because Tug is managing the asset allocation, and we can then go and put a call spread on top of that to generate a monthly income. Now, that's all well and good, but it's a monthly income that is not correlated to what's going on in the fixed income market, which is incredibly important. As Thomas mentioned earlier, you might be able to get 3% on your treasuries, but the value, if yields keep going up, is going to go down. And the income side of that is useful for any different investors. If you look at, there was a recent study out by a large wirehouse that said 70% of the assets that were controlled at that firm by client level, 70% were assets that were held in retirement accounts amongst the baby boomer generation. What do they need in their portfolios today? Income. If they've spent their entire career amassing wealth, and now they're in the distribution phase of their life, well, they need to be able to generate income and do so in a way that can be consistent and can be non-correlated to traditional fixed income environments. And that's the potential that you can get with something like a tug and a growth in income. Or you could look at an investor that maybe is not in their retirement years, but they still want to have the ability to manage some downside risk and simply reinvest those dividends over time as they're in their accumulation phase. So you can have a portfolio that's in an accumulation phase that's reinvesting those monthly dividends. And then once they get into the retirement phase of their career, they need the income, the distribution, you turn that off, and now you can simply pay out that distribution over time. There's lots of different strategies out there right there. The dampened volatility piece, again, we kind of hit on that earlier. The rebalancing tool, now is probably a little bit earlier in the life cycle of just the calendar year of thinking about tax loss harvesting or tax loss selling. There's a lot of portfolios. The NASDAQ 100 is down 30% this year. The S&P 500 is down 21% this year. A lot of bond and fixed income positions, a lot of areas that are being utilized for income are down notably this year. And so now's not probably too early to start thinking about that. Can we harvest some losses and rebalance that back into an investment strategy? Maybe something like tug, if you didn't need the income, or a tug in that's got the asset allocation alongside the income component to it. So those are just a few ways that we're not only seen, but we have seen tug as an investment strategy be utilized over the years. And now, once again, it's available in a tax efficient wrapper that is platform agnostic when we look at it, the marketplace. So with that said, our compliance department tells us this is the most important slide in our presentation. So I trust that everybody will sit there and read this information word for word, but it is important. We will be here. I do want to flip over and put our information up there. I know some of you may have some questions. I don't know what our time looks like. I think you can use the Q&A function within Zoom if there's any questions you wanted to answer now. If there's not any direct questions right now, you've got Thomas's email address, my email address on the screen, and feel free to reach out to us. But Michael, I don't know if there's any questions on the line, or Thomas, you had any follow-up comments from there?
No, I don't. I think one of the things that's fun about this is you and I have both experienced how tug reacts to things. I think again we have no predictions on what the future holds. So it's fun right now to know that again tug right now is looking for what we would call a bear market rally. Again, and not an opportunity to get fully invested in equities, but an opportunity to try and take advantage of the next strong rally that will occur. Because even if this market continues to seesaw its way down, those teeth that move up are moments in time when you want to try and capture even a few percentage points. The system is very much geared toward making good decisions quickly. With the intent of saying, I want to position some part of the portfolio to take advantage of what's happening in the market or to avoid what looks like potential issues. So right now, we think we're well positioned for what comes next. Michael?
Yes, guys, thank you so much for your time today and the presentation, and congratulations on the successful launch of TUG, TUG and TUGN. I wish you guys the absolute, best, success, luck in these markets. And what we'll be doing is we'll be following up with a recording of today's presentation. We'll also include a link to the marketplace listings so that people can download a PDF version of the materials today. Thank you both for being on. And do you have any other closing remarks that you would like to include?
Not for me.
The only thing I would say, Michael, thank you so much for your partnership. Thank you all for taking the time out of your afternoon. I know you've been on calls, not just with us, but it's been an event. And I think it speaks volumes to you taking time out of your day to listen and hear what's going on out there in the world. I would just say, don't hesitate to reach out to us. You have our email address. Our website is STFM, so it stands for STF Management. There is information that is out there in terms of fact sheets that get updated monthly. There's information out there on holdings, as Thomas alluded to, as this market environment has been very difficult, has been a market environment where it's been tough for stocks and especially long duration government bonds. If you go out onto our website, you'll see our holdings. They are that of certainly a risk off type of market environment. And that's one of the biggest questions, Thomas. And maybe you could spend a minute talking about one of the biggest questions we have from investors now is, okay, great, we are in a risk off environment. I understand why. If this market turns in a big way, how quickly or what could we expect for a portfolio to get back reinvested?
Yeah, so it's an interesting thought to take a look at. We did mention there's a specific rule built into the strategy. We call it the bear market rally rule. Again, we're looking for very specific, easily identifiable conditions in the market. It isn't basically calling a bottom. It's a bottom has happened, and now the momentum has shifted, even if it's just ever so much. But the system is looking for that. It's attenuated to that, and so it can make a move up. And so one of the examples of it is you go back to a year like a 2009, and March 9th is the bottom of the market. Tug would have given a signal to go into the NASDAQ on March 12th. That is pretty close to the bottom. So it is the flip, if you would, of the February 19th into February 22nd experience of getting out, or the Tug basically signaling before Thanksgiving, you don't want to be 100% long the NASDAQ 100. So at the extremes, Tug will never get you 100% in or out at the tops or bottoms of the market. But what it's going to try and do is to look for those entry points where, again, or the exit points, where we can go back and say with confidence in the rearview mirror, that was a good move. And that's what you're looking for in an asset allocation program. And that's why Tug, as a tactical system, does make a lot of trades. We can get through a year like a 2017 with just a handful of trades, maybe 4 or 5 or 6 all total, because the market's more or less moving in one direction. The momentum is all positive. In years like we've seen 2015, as we demonstrate here, 2016, we are going to take and make more trades, because now what the action demands it. The market's movements demand a more flexible and a lighter touch. And so we're going to try and make those incremental moves.
Yeah, that's right. And I think one of the big things that I always come back to is a tactical system. You mentioned you're not selling the top or buying the bottom, but if we can capture the big moves of the middle and be on the right side of the big trends, that's what's ultimately more important to us.
Yeah.
And while that's the case, it is an active strategy. So in theory, there's not a set rebalance date. We could make changes every day, in theory, if need be, or we could go long stretches without doing it. It's based on what the market is telling us to do. And so it can be very reactive, but if the trends are in place, then we don't have to trade.
We don't have to trade anything. Again, this is why I think it's so important. The part of the presentation that we mentioned, it is not the why, it is the what. At the end of the day, most of us actually invest based on themes. I want to buy real estate because blah, blah, blah. I think the demographics at this location are good. I think the tax base or the tax structures are favorable versus some other place. I think there will be people moving here because of geography, weather, etc. And you can make a very sound argument for all that to be the case. But if it doesn't happen, then the investor comes back to you and says, why? Why didn't it work? Of course, by the time you answer the why question, it's too late to take advantage of the information. What is a question that you can answer definitively, and more importantly, is actionable. So for us, this is why we always spend time, as a part of a follow-up with you, if you ever want to get together and say, what is Tug doing? That's the right question. And then we'll simply pull up a chart of the NASDAQ 100 or whatever index it's running against and basically say, let's take a look at it together. And that is the transparency that you have with this simple system. Michael, thank you very much, sir.